So analytical procedures is where we're ready to pick up. So let's pick it up. So that's still on our week 4 materials, but we decided to cut that a little short last time. This is something that you do, something you have to do. You're required to do in the planning phase of the audit, and you're also required to do it again in the final review stage of the audit. And you can also, if you want, you're not required to, you can use it in the middle of the audit for some of your testing. So you can use this all over, but you are required to use it at the beginning and the end. That's good things to know when it is actually required and when it's not. So that's very important. But what we're doing is we're looking at, let me change that. Doesn't have to be financial information. It can also be non-financial information. But we're looking at financial information and non-financial information. We're looking at relationships. You know, it's always a fun way to, you know, kind of get into the audit. And you're looking at trend analyses, you're looking at ratios, you're looking for weird things. You're looking for strange occurrences, odd relationships. You know, seeing these things might improve our understanding of what's going on. There may be an explanation for it. Like, hey, why is receivable so high this year? And it's like, oh yeah, well, this, and this, you know, happened right at the end of the year. So our receivables balance is kind of out of whack a little bit because of that. So it might help us gain an understanding of what's going on. And it might direct us to a problem area. This doesn't look right. What is the deal? So, you know, we in our audits, we usually just looked at a trend analysis to see, you know, how much did this go up or down, and that was, you know, that was automatic. We would do that every time, and we didn't often go too deep beyond that because our audits were fairly small anyway, and we were kind of all involved testing everything pretty heavily too. So, but it was always kind of a fun thing to do. Yeah.
What if there's an accountant behind that knows how to do it and you don't see it?
So you're saying, what if there's somebody cooking the books and hiding things?
Yeah.
Well, we'll talk about fraud and our responsibilities for that here in a minute. But, you know, analytical procedures isn't, you know, analytical procedures are really broad, right? You know, they're not a strong audit test at all. So we're just kind of getting an understanding. We're looking for things that jump out at us, right? To kind of help us draw our attention to those things. But our audit test, our audit should be designed to where anything that's materially misstating the financial statements, we should catch, right? That's theoretically what should happen. Now, you know, if there's upper level management involved and there's collusion among a couple or 2 or 3 people, and, you know, that makes it really difficult. But
Would the trial balance and financial statement rely on?
Pardon?
Would the trial balance and a statement that you can rely on?
For the analytical procedures, yeah, that's what we would do ours on, is a trial balance. Yeah, account by account. Now you can get a lot more detail. Now, to answer your question about fraud, though, if we're suspecting that fraud is going on at this stage of the thing, we're probably not going to be involved with this. We're going to withdraw from the engagement if we have a strong expectation of fraud. We don't want any part of that. But analytics they can be a strong thing. So, you know, if you are involved, I mean, I used to teach a whole class on fraud analytics, ratios and different models that we could use that would pinpoint red flags regarding fraud and stuff. So, but that's not really what you would do in an audit. You're not after fraud. That's something you more like a fraud examination. You'd be doing that kind of thing. So, pardon? Yes. Mm-hmm. Yeah. So yeah, I mean, as you're doing analytical procedures, you're really not going to be concerned, like, okay, I'm happy with these procedures. Oh no, what if they cook the books? That's really not what you're thinking. Now, you'll definitely consider those things. We haven't gotten to that discussion yet, but you're required to consider fraud. You're required to have a brainstorming session among all the main people on the audit team anyway about fraud. So you will address it. So in analytical procedures, you are required to use it in the planning stage. All right. Beyond that, you're also required that you perform analytical procedures specifically related to revenue. Revenue is an automatic high risk of fraud area. So you're required to specifically do analytical procedures related to revenue in order to maybe identify unusual transactions that, again, our whole thing we're looking for is misstatements. So we would look for relationships that might indicate some kind of material misstatement, including a misstatement due to fraud. So error or fraud, we're responsible for any misstatement regarding financial statements, whether due to error or fraud. So yeah, we do kind of have our eye on it a little bit. But yeah, if they've cooked the books and disguised it and our procedures don't catch it, hopefully our audit procedures later should. But yeah, I mean, when we think of analytical procedures, we think of things like trend analysis and ratio analysis, things with a dollar sign in front of it. But you can also do analytical procedures on non-financial things like amount of inventory, number of inventory items, warehouse space. Do you have enough warehouse space to theoretically hold this number of inventory? Because people overstate inventory a lot. Number of employees, that kind of thing. So it doesn't have to be dollar figures that you're doing your analytical procedures on. It should be anything that you find useful. All right, so required in the planning stage. Required as a final review. Can be used as part of your audit tests. It's not particularly strong evidence, so you would need more. If you've got a fairly low risk area, you can use analytical procedures to kind of, at least be your main test, but you still need to kind of do a little more probably. And then as your final review, you go back and look, and this would probably be a manager or a partner with more familiarity with the industry, with the company and that kind of thing. They're going to have a final look at things just to make sure everything kind of looks right in the final review. So required at those two spots. But yeah, bottom line, you have expectations about what you expect to see. You're going to look for differences and then kind of highlight that and then dig a little deeper later. Analytical procedures can be useful compared with other procedures to find omitted things. Omissions are hard to find because where do you look, right? So those are a little harder to find, but analytical procedures can be useful for that. And then they give you just some things to kind of consider as you're looking at analytical procedures. Things are out of whack, other things that could cause it. If you're in a crazy dynamic environment, it won't quite be as predictable as if you're in a stable environment. Balance sheet's a snapshot in time, so things can be a little off as far as this year versus last year, just depending on what happened, the day or two before, right? Income statement items are more predictable because you got a year's worth of stuff. As management discretion increases, predictability tends to decrease. Data tend to be more reliable after they've been subject. If they've been obtained for an independent external source, and they tend to be more reliable in a good internal control environment. That's obvious things, especially the good internal control environment. There you go. then the rest of this is just kind of there. You must document what your expectations are. You must document the results of your comparisons, and you must document the results of any, document everything, you know, that's our rule of thumb on documentation, right? If you do it, document it. Why not? So there you go. They gave us way too many questions on analytical procedures. Some of these are pretty crappy. First 5 of them are kind of junk. So let's get on into some maybe of the better ones. And all of them are fairly straightforward. You know, number 6 is where kind of the good questions begin anyway. Which of the following is an analytical procedure that an auditor most likely would perform during a final review stage? Simple question. 2 of these answers are things they would do in the planning phase. A is and B is. B, analytical procedures aren't applicable to. So it's just a real simple idea of what does the analytical procedure kind of look like in the final review stage. They're reading the financial statements and considering whether there are any unusual or unexpected balances that maybe didn't get identified or weren't explained or whatever. 7, 8, 9, real obvious. Oh, aggregated at a high level, what does that mean? So, you know, like if you take a single number on the financial statement, you know, it's condensed high level aggregation, right? Maybe like revenues, the year's worth of revenue, that'd be very much all the revenue activity aggregated into one number. Less aggregated might be monthly numbers or something like that. So disaggregated, you know, into here's a month's worth. Here's monthly revenues for this source, this source, this source. I mean, you can disaggregate it as much as you are able, as much as you want to. Our notes make the point, the higher the level of aggregation, the more obscured relationships tend to be. If you start picking them apart and maybe, you know, revenue from different product lines or that kind of thing, it might highlight things that are going on a little better. Right. Yeah, instead of 2020 versus 2019, you might look at January versus January, February versus February, March versus March. Oh, something screwy happened in March. I need to zero in on March and see, you know, that kind of thing. But it all may even itself out at the end. I didn't mark any as, ooh, let's talk about this one. Most of my notes on each of these are obvious, super easy, obvious but good. Straightforward. Yeah, I think they're all pretty easy. We'll move on. So there you go. Not a whole lot to say, I guess, about analytical procedures. Pretty easy. Those first couple of questions I thought were horrible.
Yeah.
Yes. Yeah, like
there's one right here for like a decrease in retained earnings.
that was the one I was going to. I disagree with that completely.
That one.
I think number 1 is just complete and utter junk. Because, you know, the way they had, and this is an author question, it's not an old CPA question, but it says in number 1, an auditor who performed analytical procedures that compared current year to last year noted a significant increase in income. Given this result, which of the following expectations of recorded amounts would be unreasonable? A decrease in retained earnings wouldn't be unreasonable. What if they paid it all in dividends? Retained earnings would be right back down. So, yeah, I think that one, I don't like it at all. Yeah, I mean, if they paid, they can pay or not pay dividends, but if they earned, you know, $1 million of income and paid $1 million of dividends, then retained earnings wouldn't move unless something else happened. You know, beginning retained earnings plus net income minus dividends equals ending retained earnings. So the fact that they say unreasonable is what I don't like. If they said would be something you would look into, I'm like, oh yeah, I'd look into that. But and from everything I've ever been taught and everything I've noted, as sales and income goes up, so does pretty much everything. So I'm looking at this and saying, I feel like a decrease in accounts payable would be kind of something to note. They said, oh, with all the income that you've earned, you would be able to pay those down. You don't want to do, you still, you delay paying payables as long as you can. There's no reason to pay those off. I feel like the more sales you're recording, the more inventory you're having to buy, the more payables you're going to have. I think this whole question is completely off. Okay. This next section is just, there's nothing for us to talk about. There's my notes on it. I mean, just because that's what I put on there, my intention is not, oh, let's skip that completely. My intention is still read everything, because those of you who have taken sections of the CPA exam know that they'll come at you with some off-the-wall stuff no matter what. So the more you read, the more you kind of are exposed to different things, the better. But beyond reading that, I didn't see anything to take notes about, really, So if I'm studying for the CPA exam, I don't jot anything down on that after reading it. I don't need to revisit any of that. It all seemed really logical. And like, how are they going to ask me a test question on any of this? So that's where I was at on that. We'll skip the questions too. Those weren't worth looking at. Okay. Now the fun stuff. Fraud. So we have a section on detecting fraud. What is our responsibility? So our responsibility regarding fraud, we're interested in anything that causes a misstatement on the financial statements, error or fraud. So a lot of this is, what do we do when we find fraud? How do we handle it? How do we respond to it? So we've got, I think, 3 sections on, well, 2 really, fraud and then illegal acts. But this is fairly easy stuff, and good for test questions too. So what is fraud? This is important. To be fraud, it has to be intentional. Otherwise, it's not fraud. It's an error, right? So fraud is breaking the law. So it's intentionally doing something wrong, right? You're intentionally trying to deceive, or you're stealing, or something like that. We have the fraud triangle. So that, as auditors, we would be aware of the fraud triangle, risk factors that we need to kind of consider. What incentives or pressures are there for people in this organization to commit fraud? What opportunities do they have to do it? And then, harder to consider their attitudes and rationalizations, but that is also something you can consider as you're considering the overall environment. And if you kind of assess that there's a terrible tone at the top, then you're like, okay, bad attitudes here, rationalization of employees are going to be like, well, management doesn't care, I'll just do this, So you consider all these risks. So that's your fraud triangle. Good things to know for sure. So those are your risk factors. 2 types of fraud. You got fraudulent financial reporting. So these are cooking the books, right? Misstating things, trying to fake out the financial statement users to make it look like you're doing better than you really are. Or you could fraudulently misstate to make it look like you're doing worse. You may have the incentive to do that. save you tax money.
Most of it's outside of.
Yeah, I mean, most of the time you're overstating revenues and overstating assets and things like that, but you might go the opposite way. One classic thing is, I'm already kind of at a loss. I'm just going to, they call it the big bath. It's like, well, I'm just going to grossly understate everything that happened, shift it over into next year so I can make next year look so much better. So there's incentives to do different things for different companies, but usually they're overstating revenues. So usually you got CEO, CFO, top people kind of involved with these things, fictitious journal entries, management override of controls is one of those very important things that you'll need to consider. Misappropriation of assets is just stealing stuff. Usually you got lower level people doing that, and that bothers us as auditors because they're stealing assets, inventory perhaps, that the company thinks they have. So what? Inventory is overstated, right? Inventory is on the books, but the inventory doesn't exist. And whatever else assets. So embezzlement, stealing, converting assets for personal use, that kind of thing. So our responsibility, like I said, we are planning the audit to give us reasonable assurance of detecting any material misstatement, no matter what the cause, right? But we will specifically assess the risks of fraud. That's required. We are specifically required to have a brainstorming discussion to consider how they might pull something off. And these are always fun. I always enjoy these. I did when I was doing audits. So you'll think of things like, yeah, that person's kind of shady. Oh, I bet we need to watch that person. They have the opportunity to do this. Oh, that inventory is wide open for anybody to grab. Nobody's monitoring that. That kind of thing. Here's that very important word again, maintaining professional skepticism. There's that about analytical procedures. So, we want to have discussions with management. We want to inquire of them, do you have any suspected fraud, any allegations of fraud that have come up, any problem areas that you like kind of wondering about this person? Y'all got your eye on them? Should we zero in on some specific area? And then we'll also want to know, how do you communicate to everyone about fraud, and what kind of tone, you're assessing their tone and at the top and everything. And then on your analytical procedures, especially involving revenue accounts, because that's always a big risk factor. And there's your fraud triangle again, a little more specific. But you've seen these before, and I'm sure you've talked about them before. But incentives and pressures. Are there high expectations that budget things that people are pressured to meet? That's a fraud risk factor that you would want to consider. Are economic conditions kind of going down the tubes? That would create pressures for fraud to happen. Opportunities, related party transactions. That's something we always want to pay attention to. Business operations in tax haven jurisdiction. That's a little out there. Significant management estimates, bad monitoring, complex organization. Think Enron. That was like so very complex. Bad internal controls creates an opportunity. So these are all risk factors we want to consider. Attitudes and rationalizations, we would assess things like level of commitment to establishing some kind of ethical standards and enforcing them. Have anybody violated things in the past? that kind of thing. And then, so important, management override of controls. So what does that mean? It's a term we use a lot. It just means that these controls that management have put in place, they may be such that management themselves aren't affected by those controls. That's the problem. They're able to override those. They're able to sidestep those. They're able to do these things without leaving an audit trail. So that's a big risk factor that we need to consider. So we need to plan to specifically address that in our procedures. And then they kind of make, back on the idea of estimates and things like that. It's always good to look at last year's estimates and see how realistic they turned out to be. Obvious audit procedure you want to do. We call that a retrospective review. I don't know how important that term is, but it is anyway. That's a fun little section to read. All the questions are good on these. There's tons of them. 13 of them. Don't you love getting to those sections where there's only like 4 questions, and then you see 13 or 15? It's like,
Even at this point, it's under 10, I'm fine.
if it's under 10, it's great. 10, you start seeing those double digits. So, this first one is just a simple but really important definition of fraud: an intentional act that results in material misstatement of financial statements. It's not unintentional. So, very important definition. 2, there's those buzzwords again about professional skepticism. That's an extremely important concept. Number 3 is a good question. It says, which of the following factors would be most likely to heighten an auditor's concern about the risk of fraudulent financial reporting? So this is one of those you got to read kind of closely. Risk of fraudulent financial reporting, right? So A says large amounts of liquid assets that are easily convertible into cash. Well, that's a problem, but that's a problem that would be misappropriation of assets, right? We're talking fraudulent financial reporting. The opposite would be a threat. High growth and profitability would be a red flag more than low growth and profitability. They tend to overstate things, right? Or if they've had growth year to year to year, that creates an incentive to continue showing that growth. You don't want to show a slowdown of that growth, right? So they may have that incentive to keep showing it. But low growth and profitability, that's not going to heighten our concern. C, financial management's participation in the initial selection of accounting principles. They do that. That's normal. There's nothing wrong with that one. But the problem would be an overly complex organizational structure involving unusual lines of authority. You got this crazy complex organization you're trying to audit, and creates a lot of opportunities for things to get lost in the mix, right? Think Enron and how crazy everything in that organization was, and how difficult it was to make sense out of all the crazy mess they had going on. 5, questioning mind. That's one of those kind of buzzword type things. So that's kind of what they're getting at with number 5. Questioning mind. Not the best question ever, but I could see it being a question. So 6 is kind of jerky in a way. It kind of requires you to have a little bit of outside knowledge to answer which of the following situations most likely represents the highest risk of misstatement from misappropriation of assets. We have to know what a bearer bond is to be able to really answer that. But a bearer bond is, whoever has it can spend it, right? So that's funny. I always think of Beverly Hills Cop because it was all about these German bearer bonds.
Really?
Yeah. See, you can learn a lot from movies or TV shows. Yeah. And I get some books and stuff, but
They're not as fun.
no, they're not as fun. Yeah. I mean, I think the whole bearer bonds thing, I mean, if they'd said a large number of cash sitting around, we'd be like, oh, well, obviously. So I think it's just the bearer bonds that throws us off because we don't know what those are. Yeah. It's essentially the same as saying a large number of $100 bills sitting around the office for the taking. Yeah, it's kind of a trickier question. 7, while performing an audit on the financial statements of a company, the auditor notes that the company's sales increased substantially in December with a corresponding decrease in January. And, that might kind of get at what we were just talking about with these large number of transaction report processed in a short period of time. They may have been trying to do that. Didn't specifically say December in that last one, but anyway, they processed a bunch in December and decreased it off in January. In assessing the risk of fraudulent financial reporting or misappropriation of assets, what should the auditor's initial indication about the potential for fraud be? Plain and simple, there is a broad indication of financial reporting fraud. That's a big red flag is another way of saying D. Yeah, it looks a whole lot like income smoothing. We need some revenue on the books. We'll put it on there and we'll take it away later. And a lot of frauds kind of begin that way. All right, let's meet these projections now. We'll catch up and clean it up. And then it snowballs. Health South for sure did that. Yeah, they always intended to go back and smooth it back off and just kept digging themselves into a bigger and bigger hole.
You think there's companies that do that and do actually go back and fix it never again?
Probably, yeah. I mean, it's part of them trying to hide it. Do they do it and never do it again? That's probably less likely, but it's just, the classic story you hear from these guys who come and speak about their involvement in a fraud. It's like, at first I said no, and then I finally gave in because I had the intention of, okay, just this once and we'll fix it. And then just this once became, well, let's do it one more time. And then it just kept, going and going. It was pretty simple. But good, we provide the same assurance regarding errors, irregularities, and illegal acts. Reasonable assurance. And again, notice that this is our concern. How do these things affect the financial statements? That's all that we're really looking at. Nine's kind of a classic. Which of the following statements best describes an auditor's responsibility to detect errors and irregularities? An auditor should design an audit to provide reasonable assurance for detecting errors and fraud that are material to the financial statements. Just did the same thing in 8, just worded a different way. But know that by heart. I mean, that's very important. Yeah, it shows up over and over, asked different ways, and sometimes asked exactly the same way.
Yeah. As long as you just memorize the auditor's responsibility there.
You should, yeah.
Yeah, said because they break that down and reword this and reword.
Yes, yeah. So the comment was made in class. It's good to memorize the auditor's responsibilities and the management's responsibilities from the audit report or the engagement letter. I memorized we used to call it the unqualified audit report. It's unmodified now, but I just memorized that word for word when I took it. It helped a lot.
It's still unqualified for public companies, but it's unmodified for.
I wish they'd leave things alone. You get used to saying something and then,
Yeah.
then you have to change it.
This unqualified does have a year.
It sounds bad, doesn't it? So, you know, and that, you know, say you're presenting your audit to, you know, some town hall meeting or something, you know, you did a little municipality audit and you're presenting it to whoever, and you're like, that was an unqualified, oh no, an unqualified, that's, oh no, that's good. Yeah.
If you say you're unqualified to do this, like, here's an opinion I'm not qualified to make.
Right, right.
It
So,
sounds good. I understand what.
yeah, what the guys that I used to work for used to, when they were presenting in a thing like that, they would just say it was a clean audit opinion. Just to, they would always make a point to do that because it does sound bad, unqualified.
Thanks for changing some of that. I like the change, but also when I do it.
You hadn't had to do it for years, yeah.
It makes more sense.
It does. Yeah, it was a bad name to begin with. 10, same question, same answer. Just to repeat. 11, we've seen this before as well, but it's kind of a classic type question too. An auditor who discovers, I mean, we haven't seen this exact question, but we've seen the concept time and time again. An auditor who discovers that a client's employees have paid small bribes to public officials most likely would withdraw from the engagement if, and sees the answer, if those actions affect our ability to rely on management's representations. You know, if we have a problem with management and our ability to rely on them, we have a problem we can't really fix, right? So that's the answer to that one. Let's see, 12 is a good question. An auditor of a non-issuer exercising professional skepticism with respect to the risks of material misstatement due to fraud will most be this one's really quite easy. But part of it's easy and part of it's not. It's easy to rule out A. We're not going to adopt an attitude of acceptance unless evidence indicates otherwise. That's the opposite of what we do, right? We are having a mindset of professional skepticism. B can throw us for a loop because we haven't really learned yet, but we'll later learn that we're not required as auditors to authenticate documents. So that comes a little later. We don't have to authenticate things that we use as audit evidence. It's too much. But we do need to consider the reliability of information that we're using as audit evidence. Why wouldn't we? Why wouldn't that be the answer, right? So that makes it kind of easy. And then 13. Okay, 13 weeks ago. Okay, questions on that one on fraud? I love the fraud stuff. Always interesting. So we get a little more of it with the next section. Fraud, evaluation, and communication. So, you know, we were talking about in the planning phase before. Now what? As we're nearing the end of the audit, you know, the point they make time and time again is the things you do in the planning stage doesn't mean you can't go back and revisit and reassess. You should. So they make that point immediately near the end of the audit. You should evaluate whether the results of your procedures affect your initial assessment of fraud risk. And keep going until you're satisfied, right? Any identified misstatement should be considered whether they could be indicative of fraud. So anytime you see a misstatement, that should be in your thoughts, like, all right, could there be something kind of screwy going on here? If it's a result of fraud, what do we do? Or if it may be the result of fraud, if you're thinking, this could be a problem, what do we do? Well, we want to get more evidence to get a clearer picture for sure. And then we want to discuss with management. And it's always one level above the people you believe to be involved. So you'll get questions about who do you talk to, and that's the answer. You might have a question about you found fraud and you immediately go to the president of the board or something like that. No, you don't. You just go to a level above who you think's involved. You don't automatically go to the top. You may end up having to go to the top. You don't automatically go to the top. And you should always consider what your legal responsibilities are. And maybe if you need to end up withdrawing from the engagement, reasons you might withdraw, all again goes back to, all right, we're in a position that there's no way out. And it always has to do with crappy managers who aren't doing what they're supposed to do. An entity that doesn't take appropriate action regarding fraud, evidence that suggests there might be pervasive fraud, concerns about competence or integrity of management. You don't want any part of it. Get out of there. So there you go. This right here is, it shows up a lot in a lot of things. Required documentation, everything. You know, I just can't imagine a question saying you shouldn't document something. So I think it's just going to be, why wouldn't you document? Required communications when fraud is either suspected or detected. If it's not material to the financial statements and senior management is not involved, just go to the appropriate level of management. If it is material, or if senior management is involved in the fraud, those charged with governance. So that really kind of goes back to what we highlighted here, right? The level above. But if it's material, obviously the people in charge of governance would need to know that regardless of who did it. I think that would be obvious to you. And here's the thing about whistleblowing. So, informing others outside the entity is usually not appropriate. But we always want to seek legal guidance. You know, what are my responsibilities here? But exceptions, you know, areas where you could go outside of the company with this information, subpoena. That's always they subpoena something from you, you're going to do it. Compliance with some kind of regulatory requirement, predecessor auditor. You can discuss those things with the predecessor auditor. Again, we talked about before what the appropriate method is to even do that. So you got to get client permission to do that and all that, right? And then I think this is what you were saying a second ago, you are able to report to the funding agency under governmental auditing standards. Pretty quick and easy little section. Only 4 questions on that one. That was nice. Let's look at the first couple. Simple things we just talked about, really. Number 1 says, during the course of an audit, an auditor finds evidence that an officer has entered fraudulent transactions in the financial statements. The fraudulent transactions can be adjusted so the statements are not materially misstated. What should we do? So one of the top level people have fraudulently done some things, we can adjust it to make things fine. What should we do? We communicate it to the level above them. Those would be those charged with governance. We don't automatically do anything drastic, right? You know, a lot of questions will kind of lead you down that path. Like, oh, you found this fraud. What should you do? Get out of there. No, you know, we don't automatically do anything drastic. We don't go to the authorities. We don't immediately go with a scope limitation or, you know, disclaimer or qualified opinion. You know, we can deal with this, and that's what we want to do. We found a misstatement. We can have that fixed and keep moving. So it doesn't mean you can't have an unmodified opinion. We want a solution, right? We want to be able to have these financial statements presented fairly. We'll get that fixed. Number two, during the audit, auditor discovers a fraudulent expense reimbursement for a low-level manager. You see where they're taking you with this one. The auditor determines it's inconsequential and several similar transactions will not be material. All right, so the fact that it's not material means we don't have to go to those in charged with governance. So we just take it to the appropriate level of management. All right. And skip the rest, but fairly straightforward. Detecting illegal acts. Not a whole lot of new things to say here. So just like anything, we as auditors should perform procedures that may identify any non-compliance with laws if they have a material effect on financial statements. Again, that is what we're worried about. So we're not worried about really, you know, it doesn't sound right to say, but we're really not worried about anything else. We're not in the business of making sure that they're complying with these laws and things that don't have a material effect on the financial statements. Our goal is to check out the financial statements, right? So we're worried about non-compliance that could result in them getting sued. That would be, you know, potential for misstatements on the financial statements, you know, fines, anything that could affect the financial statements. So if there are laws in place or regulations that have a direct effect on the financial statements, we need to obtain sufficient appropriate audit evidence regarding that. And that's about it. Not much else to say on that, really. Oops. One, regarding compliance with laws and regulations, an auditor is responsible for which of these things? So the thing we end up being responsible for is obtaining a general understanding of the legal and regulatory framework and how they're complying with that framework. Of course, we want to do that, right? As we're gaining an understanding of this entity and its environment, that's the kind of thing we need to take note of. But notice what we don't have a responsibility for. We're not responsible for preventing non-compliance. We're not responsible for determining whether an act performed by the entity constitutes non-compliance. And we're not responsible for ensuring that they are conducting in accordance with the laws. That's not what we're up to. We're not in the business of preventing or ensuring, you know. That's a strong word there. Number two, during the audit of a new client, the auditor determined that management had given illegal bribes to municipal officials during the year and several prior years. We notified the board. So the board, that's the people in charge of governance, But the board decided to take no action. That's one of those things where we're out of there, right? So there you go. All right, that's good enough. Those are obvious ones, I think. All right. Hey, look at 4 though. 4 is a little hard to deal with. Which of the following information discovered during an audit most likely would raise a question concerning possible illegal acts? So A, we can throw out, related party transactions that are properly disclosed. That's fine. We didn't talk specifically about related party transactions, but we will. But you can read that and be like, that's obviously fine. B says that the entity prepared several large checks payable to cash during the year. I mean, we know that's a big no-no, right? I mean, you don't do that. But C kind of makes you think too. Material internal control weaknesses were previously reported to management, but were not corrected. So that idea shows up a lot. And it's always tempting to answer, but remember that there can be internal control weaknesses that aren't worth fixing, right? Because of cost benefit. Like, yeah, it'd be nice to fix that, but it would be more expensive to fix it than the benefit that we would get from it. So watch out for that one because it shows up a lot and it's usually not the correct answer. It just looks like it should be. Yeah, it's easy to answer that one. So yeah, make a note on that. Yeah. The point with this one is you're really losing your audit trail. Like, okay, where did it go, right? So, if I'm doing the accounting for my church, and if I see a big cash check, I'm like, okay, where did that go? And they might say, oh yeah, that went to so-and-so. And I'm like, okay, it'd be nice to know that was, I trust you, but it'd be nice to know that it really did,
Yeah.
Using the work of a specialist. So I know I say it time and time again, but I love these little bite-sized chapters. It's like, here's everything contained in one little spot about using specialists. So what's our objective? First of all, what's a specialist? So we might need to bring a specialist in to deal with an area we don't know about. Like maybe there's some priceless art involved and we don't know how to value priceless art. So we might need to bring a specialist in to value that priceless art. Mineral and oil reserves, we don't know what the heck we're doing with that. So we need to find somebody who does, right? But then less drastic things such as, interpreting contracts. Like, okay, this is heavy legal stuff. Let's get a legal guy in here to figure that out for us. Actuarial stuff, valuation things. So that's what we're talking about. So we need someone, and the definition of a specialist is some expertise in a field other than accounting or auditing. So we're going to rely a little bit on what they're saying, and we're going to use what they're saying as our audit evidence regarding whatever area we're auditing. So our objective is to determine whether we need to use a specialist, and then to determine whether the work that the specialist does is adequate for our purposes. Probably the most important statement on this whole section is this: the auditor does not divide responsibility, ever, right? Never, 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 never. So the auditor has the responsibility. There's no sharing of responsibility. Using a specialist doesn't reduce their responsibility. It just doesn't happen. So what do we need to do? We need to make sure that the specialist is competent, make sure they're objective. We need to get a sufficient understanding of their field of expertise so we can kind of figure out what they need to do and to be adequate, right? we need to somehow evaluate the reasonableness of what they've concluded. We might make inquiries of the specialist to do this. We might perform some kind of procedures to corroborate it if we're able to do that. We might discuss things with another specialist to kind of corroborate. So, do any of those kind of things. What if it turns out the specialist work is not adequate? We'll do more. So, questions will often lead you down that path. You know, so-and-so was tested and it turned out it wasn't adequate. What should we do? Figure something out to where it will become adequate, right? So require more work, perform additional procedures ourselves, or if we have to, we might have to modify the report for a scope limitation, but hopefully we wouldn't have to do that. And what about in the auditor's report? If it's an unmodified opinion, no reference to the work of the specialist. If it's a modified opinion, we could reference the specialist, but only if it would help the readers understand why we modified the opinion. So very specific instance when we would reference the specialist in the report. But most of the time, no, we would not. But yeah, if you're modifying the opinion because of something there, and you need to reference them to make the readers understand, then you can do it. But you'd want to mention in the report, though, that just because I'm referencing this specialist doesn't in any way reduce my own responsibility for the opinion given in the report. You know, you want to make sure that you're not being perceived as dividing responsibility between yourself and the specialist. It's all you. Well, just I guess it depends on, it could be anything. Or where do you reference it? I don't know. It's such a oddball thing. I don't know where it would end up in the report. I guess it would be, I don't know. I really don't. I don't know if there's a specific place or not. So the question is, what's the difference between a modified report and an unmodified report? Yeah, it'd be nice for them to give us a little bit on that earlier, wouldn't it? So we've got, they saved that discussion toward the end, right? So, yeah, so let's talk for a second. So an unmodified report means everything's cool. You know, we've done our audit, we have gathered sufficient appropriate audit evidence, and we are satisfied that everything's presented fairly in accordance with GAAP. That is an unmodified audit opinion. A modified opinion might be, we are satisfied that everything's presented in accordance with GAAP, except for this, which has this little issue going. You know, we may be like, we were unable to observe beginning inventory, so we're going to issue a qualified opinion regarding the income statement because we feel like everything's presented fairly except for this because of this, right? And then there's tons of discussion on modified opinions later on, but it's essentially, you know, unmodified, clean, everything's cool. Modified could be there's a problem that doesn't affect just horribly area. But you could have an adverse opinion where things are presented not in accordance with GAAP. So we'll get into all the reports later. But yeah, for now, just think unmodified, everything's fine. Modified, everything's kind of fine except for this. Would be a quick, easy way to think of it for now. One is easy. Two, though, kind of gives us new information. So number 2 says an auditor intends to use the work of an actuary who has a relationship with the client. So you're, in other words, your specialist is not independent of your client. I don't think our book really addressed that so much until these questions, which is fine. I mean, the questions are part of our study tools too. Under these circumstances, what? Well, the answer ends up being you should assess the risk that this objectivity might be impaired. So what we can kind of take from that is a specialist's lack of independence isn't an automatic problem. We would just have to do something to assess whether there is a problem. So a little bit of new information there. But notice that C says we're not permitted to rely on them because of the lack of independence. That's not true. And we don't have to disclose that relationship in the auditor's report. Remember, we're saying we're not even referencing the specialists in the audit report. So A, we throw out.
I got the B and C, and then I said, probably C.
Yeah, I mean, it's new information. I would have wondered myself seeing it for the first time. It's like, I don't know. Seems like, I don't know, you know.
Yeah.
Can't wait to find out. And then, you know. So yeah, not an automatic problem. We just need to assess whether it is. So you add that to your notes. 3, which of the following statements is correct concerning an auditor's use of the work of an actuary in assessing pension obligations? Obviously, A, we're required to understand the objectives and scope of their work. We're not going to just blindly trust these people, right? We need to get some understanding. Strictly, this B is kind of tricky. It says the reasonableness of their assumptions, the actuary's assumptions, is strictly the auditor's responsibility. So I think strictly is what makes that wrong. Kind of tricky. And responsibility. Yeah, I don't know. B is just a little strong. Let's see. And 4, it's all straightforward. 4 talks about referring to the specialist in the audit report. 5 gets at that same idea from number 2 about we're still permitted to use their findings as evidence, even though there's not an independent relationship between the two. Six, it's a good question. So when using the work of a specialist, we may refer to and identify the specialist in the report if we express a qualified opinion as a result of their findings. Very specific question, but it's a good question. Right. So a qualified opinion would be a modified opinion. At 9, more of the same again. And then 10, like you said, obtain an understanding. Never a bad answer, right? Pretty straightforward. Good stuff. All right. Okay. All right. Fairly easy stuff for the week 5 stuff. A lot about things you're required to communicate. So, you know, that's just kind of a list of things, and really not much of a list of things because most of it's kind of obvious. So this section is required communications with those charged with governance, audit committee, board of directors, whatnot. Of course, I guess we got PCAOB communications coming up, but essentially the same. So we need to communicate, and we've talked about a lot of this already. Auditor's responsibilities related to the audit, scope and timing. Here's a list: auditor's responsibilities, plan, scope, and timing of the audit, significant findings from the audit, and then I don't think this, I don't remember, but I think I added this separate because it's covered in a later section, but I kind of wanted it here. Significant deficiencies and material weaknesses found when you're looking at internal control. paste that from elsewhere. Significant audit findings, changes in significant accounting policies. You know what? Here's a little rule of thumb. Check this out. Significant, 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 significant. Disagreements. All right, that's a good one to remember. Any disagreements with management you want to communicate. But yeah, these are easy. And as you see, as you go through these problems, significant jumps out at you on almost all of them, all of them. So that makes this kind of easy. Anything significant, you should communicate to those charged with governance. One is kind of easy. It's not really a question about what to communicate, but it's more of a question of which of these is and isn't true. Which of the following required to communicate to the audit committee? Significant? Yes. Significant? Yes. Yes. Yeah. Significant? Yes. Management's consultation with other accountants about significant accounting matters. Yeah, but that one a little trickier because it's like, really it's, do we need to report management's consultation? So that one makes it a little tricky, but I feel like you're pretty safe answering yes on that. So, four is a good one. Again, about that whole idea of disagreements with management. Which of the following matters is an auditor required to communicate to the audit committee or those charged with governance? Should they communicate disagreements with management? You can stop reading there. The answer is yes. Should they communicate auditors' views about qualitative aspects of the entity's significant accounting practices, including accounting policies, accounting estimates, and financial statement disclosures? Of course. So it's pretty simple. More the same on 5 about disagreements with management, whether satisfactorily resolved or not. 6 is a pretty specific question, but it's not a bad one. An auditor is obliged, I'm getting tired, I'm mispronouncing words. An auditor is obligated to communicate an uncorrect adjustment to an entity's audit committee only if the adjustment is believed to be trivial. Is not believed to be, I can't talk anymore, I've lost it. So this kind of gives us so it's an audit adjustment. That means that we have said, y'all need to do this, right? So in this problem, they haven't done it. They've not corrected something that we have already said, y'all need to do this. So we need to communicate that only. The only reason we wouldn't is if it's just a trivial thing that they didn't do, like, yeah, whatever, right? Yeah, any audit adjustment that's uncorrected, they need to do it. And if they don't, we need to communicate that to the audit committee. Hey, it's easy, but it does throw that word significant into everything. You just got to see how they're using it. Which of the following statements is correct concerning an auditor's required communication with the audit committee? A says the communication is required to occur before the auditor's report on the financial statements is issued. That's not true for a non-public company. For a public company, there's a little bit of a difference on that. They're supposed to report certain things before the audit report, but for non-public companies, it's just in a timely manner, so it's fine. Some things I think are specifically required to be communicated within 60 days of the audit report date, but B's the answer. This communication should include management changes in the application of significant accounting policies. And that's a significant thing. But look at C. Any significant matter communicated to the audit committee also should be communicated to management. Definitely not, right? And then 10, what is wrong with me? D, significant audit adjustments proposed by the auditor and recorded by management need not be communicated. So D says significant, but it says it's significant and shouldn't be. So makes that not true. So that's a pretty good question. 9, more of the same about disagreements with management. 10, another one that we communicate, significant accounting policies. 11, a question about a deficiency. It says employees have the opportunity to change their time worked after their time cards have been approved. What kind of deficiency is this? That's a problem with the way the control is designed, right? We designed it wrong. It's operating just like it was designed. Yes, it gives quite enough information in there, really. It does say they have the opportunity to do that. So yes, that leads us to believe it was designed that way. More of the same in the PCAOB thing. Define, we already know that. For public company audits, communications should be issued prior to the issue of the audit report. So that's kind of a key takeaway there. Yeah, there's really not a whole lot to add to this. And any of the questions are worth us looking at together, unless y'all wanted to look at any specific ones. Okay. All right. Internal control, next several sections. All right, internal control. So we're still talking about planning the audit at this point. So this is all about us understanding internal control. So we want to obtain an understanding of the internal controls that management has in place so we can plan the audit, right? So we're looking to find areas that there are not good controls, which would lead to areas of potential misstatements. We want to figure out what effect these controls, this internal control structure will have on our audit plan, right? So we want to make sure we understand the design of the controls. We want to understand if they've been put into operation and are working correctly, right? So we'll talk to personnel, we'll talk to management, we'll observe things, we'll look at documentation, manuals, and things like that. Flow charts, we might be making those types of things as a part of documenting our understanding. But there are other things we can do. But I remember, are there any classes y'all have taken where y'all had to do the little flow charty symbols? Yeah. Y'all do a little bit.
Yeah.
I think that's fine, because I remember taking a class where we had to buy a little plastic stencil thing where we could draw those symbols. I hated it so much. So much. I still have that thing, I think. I think Mandy said that she talks about it a little bit.
I did it in high school, but not for
Okay. It was tested pretty heavily on BEC when I took it. But,
Yeah, I have another class. I have the post right here.
for 390. The lines and the, yeah.
Like symbols, this is a decision point.
Yeah, and there's one for like storage and stuff like that. Yeah. But do what? Oh, I don't know. I've tried to forget all that. Yeah. But yeah, you can use those flow charts to kind of document your understanding of the control system, but there's other ways too. You can do questionnaires and stuff, or narrative write-ups is the way I would go if I was tasked with this. It makes more sense to me, but anyway. And then you can do what's called a walkthrough. That's a word or term that comes about in the real world quite a bit. Select a few transactions and trace them through. To kind of help you. You could, there's no point in getting too deep into it, but you can take a single transaction, follow it all the way through to the financial statements, or you could find key steps in the process and perform procedures at each step, but not necessarily on the same transaction. But it's all about just getting an understanding of their internal control system, how it works, whether you've understood things. It's not evidence. It's not a test of controls either. It's just to help you understand things. That's about it for that section. So thought 2 is very specific. Decision table differs from a flow chart. That seems like a question that you probably wouldn't get, but decision table, you never know, you might get it, so why not understand what it is? So with the decision table, it's like one of those deals where it's like, if you choose yes, then this, if you choose no, then this, and that's a decision table.
Yeah, that wasn't in the book.
Was it not?
Material.
Okay, I didn't know if it was or not. Or kind of more the same, but in a different way. An auditor's primary consideration regarding really anything is how it affects the financial statements, right? So this one is primary consideration regarding the entity's internal control structure, policies, and procedures is whether they affect what ends up on the financial statements. It's always what they're looking at, right? Number 5, when obtaining an understanding of internal control, an auditor should concentrate on the substance of the procedures rather than their form, because it's kind of broad, isn't it? So A says operating effectively but may not be documented. Doesn't seem like anything we care about. B says management may establish appropriate procedures but not enforce compliance with them. And that kind of makes the sentence make a little more sense. It's like, I'm not real sure what they're talking about, but reading B kind of puts the piece of the puzzle together. It's like, that makes sense. That makes this kind of logical. So you go back and reread it. So we're looking at the substance of the procedures rather than their form, because the substance would tell us whether they're being complied with. The form just says, yeah, it's there. Who knows if it's working right? So kind of one you have to pick apart to get right. But yeah, so I think the form is, here is the procedure that's in place, and concentrating on the form, be like, that's a good procedure there. The substance would be like, well, let's look at the nuts and bolts of this and see if it's working. It's like, that's kind of the way I interpret it. It's not the best question ever. It's a little broad, but form is the overall design. Substance is what it's doing, how it's doing it. It's not a good question, but they're not all good. So it's good to learn how to pick them apart a little bit. Weird questions like this. 6, I think, if I remember right, was kind of tough, but doable. In planning an audit of certain accounts, an auditor may conclude that specific procedures used to obtain an understanding of internal control need not be included because of the auditor's judgments about materiality and assessments of Okay, that's a big, tough sentence, right? So you kind of have to pick that one apart too, or at least put it in your own words. So putting that in your own words is kind of like saying, I don't need to obtain an understanding of this control because, and then the cause is there's no real inherent risk here, right? So in planning an audit of certain accounts, an auditor may conclude that specific procedures used to obtain an understanding of internal control structure need not be included. All right? So that all translated to, I don't need to test any controls because
You might not rely on.
it may not be material and there's really not a whole lot of inherent risk.
Then they might just rely on substantive procedures.
They're just
They might not
going,
even,
yeah.
for the efficiency of the audit, not even testing.
right. And we hadn't quite gotten there yet, but yeah, the whole thing with, and we have touched on it a bit, but we hadn't hit it as hard as we're going to. But yeah, I mean, we might not do any test of controls at all, and we may just completely rely on our substantive procedures, right? You know, if the controls aren't working, there's no point in testing those controls. We've seen that before, and we'll see it again too. I don't know, it's a bit of a tough sentence, but you know, we can kind of throw some of these others out once we understand what the question is. You don't have an idea about control risk until you get an understanding of the control. That tells us we're not even bothering to obtain an understanding of the control. So we can throw that out. Detection risk is a result of our assessments. We learned that last time, control risk and everything. So sampling risk, not even a term we've been introduced to yet. So yeah, it's a tougher question. But it's doable after you pick it apart a little bit. There's a definition of walkthrough. All right, yeah, good enough on this. More on internal control, evaluating internal control. So here we're obtaining an understanding of internal control. So now we are evaluating internal control. So preliminary evaluation of internal control. So, you know, in the beginning, we're going to consider whether we can rely on certain controls. You know, if we are looking at controls and we're gaining an understanding of it, and we say, well, that control is kind of crappy, then that's going to affect our assessment of control risk, which we talked about last time. We're going to say control risk is high because those controls are crappy. And then go from there, right? That would affect things on down the line. Higher control risk, accept lower detection risk, beef up your substantive procedures. But you, on the other hand, can rely on some internal controls. Controls in place, you test it, you think it's fine, that can allow you to do less substantive tests on down the road. So, you know, I like the way this is put. Reliance on internal controls buys you a reduction of substantive audit work, but it costs the additional effort to test the controls. Right? You can't rely on a control, not test it, right? So it's kind of a pay me now, pay me later thing, but your whole plan, you know, you're putting together an audit plan that's appropriate. It's like, all right, these controls seem fine. Let's test these. All right, they're working fine. Control risk is lower. All right, we can go from there. So, let's see. This kind of stuff we just said. Here at the end, they said a wholly substantive audit approach would mean no reliance on internal control, which is fine. You just say control risk is at the maximum, Not going to do any test of controls because there's no point. No point in testing something you're not going to rely on anyway. So you may just do all substantive testing and that's it. That's fine. You can't just rely on test of controls though. So that's not okay. And that's what this next sentence says. Okay, good. So you may base your conclusions on both test of controls and substantive audit procedures, but you always have to do some substantive audit procedures. You cannot just rely on test of controls. So that's pretty important stuff right there. All right. But, you know, test, there's tons of different procedures you can do. It could be inquiry, but inquiry alone is never sufficient. Y'all would know that, I think. But, you know, inquiry alone, that's not a sufficient test. You need to do something more. Observation, inspecting documents, inspecting reports, walkthroughs like we just talked about, that kind of thing. Well, not a walkthrough. That's just an understanding. Never mind. Sorry, I spoke there. Okay. Which one now, though?
I like this one. Right here.
Number one?
Yeah.
Okay. Which of the following statements indicates that the auditor has gained a sufficient understanding of a client's internal controls? In this case, they say related to the sales order process, but just cut that part off and just say which of these indicates they have gained sufficient understanding of internal control. So A says the auditor noted in a narrative that the documentation for the sales order system showed the printing of a shipment exception report listing non-invoice shipments. So I think the key word there is they noted in a narrative that this was going on, right? The whole idea here is which of these indicates a sufficient understanding, right? So it's making sure to focus on that key word because the others are tests of controls or substantive tests, depending on what they end up saying. But yeah, A is the only one kind of showing an understanding. You know, B is a sample of transactions and they found exception. That's just a substantive audit test. C says the auditor interviewed supervisor and reviewed some shipment exception reports that were randomly selected. This is also audit testing or testing controls or whatever. So yeah, that one's just paying attention to the wording. Document everything. That's easy. 3 of the following statements about internal control structure is correct. D says the cost-benefit relationship is a primary criterion that should be considered in designing an internal control structure. You know, that's true, but it doesn't jump out at you as, oh, that's definitely the answer. But you know, that is something we talk about a lot with controls is cost-benefit. But looking at the others to kind of pick them apart a little bit. A says a properly maintained internal control structure reasonably ensures that collusion among employees cannot occur. So collusion is one of the things that's often mentioned as a good way to bypass a control. That's a problem, right? So it's hard to maintain an internal control structure that'll defeat collusion. Hard thing to get by. B says the establishment and maintenance of the internal control structure are important responsibilities of the internal auditor. That's not true. Who's responsible? Management. Yes, good job. C says an exceptionally strong internal control structure is enough for the auditor to eliminate substantive tests on a significant account balance. We just said no, right? Test of controls, relying on controls is not enough. That's a good question. I like it. 4 says, after obtaining an understanding of internal control and assessing control risk, the auditor decided not to perform tests of controls. Why would that be? The answer ends up being it would be inefficient to perform tests of controls that would not result in a reduction of planned substantive tests. So that's the deal. You know, if they're understanding internal control, looking at control risk, and say we're not doing any test of controls, the reason they're not doing test of controls is because they had no intention on relying on any of those controls. They're going straight to audit tests. So that's a good thing to make sure you understand. There's no need to test anything that you're not going to rely on. It's a waste of time. All right. I like 5. It's just more of the same, but the ultimate purpose of assessing control risk, the ultimate purpose of anything, all comes down to the financial statements, right? So more of the same, but good stuff. 6, yeah. 7 makes a good point, because I don't know if we've mentioned it yet. So which of the following would likely not be considered an inherent limitation of internal controls? If you don't have this in your notes, it's worth mentioning because these are classic things. Inherent limitations of internal control are management override of control, human error, and collusion. Those are things that will render an internal control system less effective. Incompatible duties is not an inherent limitation. So, yeah, these 3 are kind of classics. So make a note of that if you don't have it somewhere else. Here's another way of wording how everything comes back to financial statements. Control risk should be assessed in terms of what effect does it have on financial statements. 9 is more about the relationship between test of controls and substantive tests. So 9 says, after obtaining an understanding of internal control, auditor decided to perform test of controls. This is the opposite of what we were doing earlier. The auditor most likely decided that it would be good to do these test of controls so we can reduce our substantive tests later. Very important. All of that about test of controls and how it affects your substantive tests and controls and when you would just not test controls. And that's all really important. Does it all make sense? I think it does. It makes pretty good logical sense. Nice and neat way. 12 is another classic that you should definitely understand. Assessing control risk, and we've already talked about it, but assessing control risk at below maximum would most likely involve what? So below the maximum. If we're assessing it at maximum, we're relying on nothing. And we're moving on to the audit test, substantive test. If we're assessing it below maximum, we got to back that up. So we got to test it to kind of give credence to our whole assessing it below maximum. So we're going to look at specific things and then go on to test those. D is not the clearest of the clear answers that they could have possibly given, but is at least working toward a test of control. It's not exactly a test of control, but you're working your way toward it. That's the best of the answers there. Everything else has to do with all right. Any of those others you would like to look at? Shall we move on? Let's keep going because it's kind of more of the same here. It'd be more efficient for us to keep on it. So a little bit of repetition here.
This section just threw me back to DC.
Yeah, it's a lot more the same. Again, you can't assess control risk so low that we omit substantive testing. There we are mentioning again that inquiry alone is not sufficient to evaluate a control. But again, our main concern is how a specific control affects material misstatements. How does it prevent it or detect it or correct it? That's what we're interested in. But the big meat of this section are these 5 things. Worth listing and remembering. So this is AICPA stuff here. So they've got internal control consisting of these 5 components. The audit plan or audit program that we used at my firm that I used to work for, we had specific checked off things on related to all 5 of these in the audit, built into the audit plans. So we specifically assessed all of this stuff. So we got the control environment. So this kind of deals with, this is the tone at the top stuff. This is the policies and the procedures that determine the overall control consciousness of the entity. In other words, the tone at the top. So we'll want to get an understanding of how management communicates its values, how they enforce integrity, but also HR type things, hiring good people and keep them going and stuff like that. But if you ever get a question leading you toward which of these 5 is kind of the, I won't say most important, but maybe like the foundation. This is the foundation for everything else, kind of, for all the other components. The control environment is. So we might ask questions of management like, do you take appropriate actions when you see departures from policies? How do you deal with alleged instances of fraud? Are you satisfied that all your employees are honest? And then we'll also kind of observe things, do they tend to be more conservative or more aggressive when they report things? And, tone at the top. Our risk assessment is management's process for dealing with risks, identifying risk, managing risks relative to preparing the financial statements. So we'll look at things like, do they have timely information coming into them? What risk have they decided to accept for cost benefit reasons? They have a disaster recovery plan. Do they assess their own, as an auditor, we'll do brainstorming sessions about potential areas of fraud. Do they do this themselves as well? Do they assess their own vulnerabilities to fraud? That kind of thing. How do they deal with their own risks relative to the financial statements? Information and communication systems. So that all has to do with identifying and capturing and exchanging of information. So we want to understand how management communicates the individual responsibilities to people in the financial reporting process. How are exceptions reported? IT stuff. Yeah, that kind of mess. Kind of a broad one. Control activities. So we know what control activities are. These are the actual policies and the actual procedures that are in place, such as authorizing stuff, checks and balances, pre-numbering of documents, like your checkbook. It's a good control. Paper trail, timely reviews, safeguarding of assets, segregation of duties is a control activity. We know what control activities are. And then monitoring involves, we know what monitoring is too, involves the ongoing assessment of, is their internal control still effective and remaining effective? So we want to see what they do to monitor this and where their information comes from and that kind of thing. And then they make the point again, internal control could be ineffective, even though it's a good control, due to human error, management override, or collusion. So these are the inherent limitations of internal control. And again, the point made over and over about cost benefit is certainly a constraint. All right, but yeah, remember this. Becker uses an acronym for this. CRIME, yeah, CRIM, and then they say existing control activities. And to me, that just makes the acronym useless because I'm like, now I have to remember that it's existing control activities, and that's a new thing to remember. And I don't.
Well, it's kind of funny because they could have just done control environment as the E.
Oh, you're right.
But they don't because it's kind of
Because
like
it's
you
the
said, it's
foundation.
like kind of like the most important one.
Yeah,
But they could have.
they should have. That would have been better.
Wanted it.
Need to write them a letter, tell them to change that. But yeah, do know those. That's good to know. It's a list worth memorizing. I like memorizing things, but it's a good one. Okay, one's a good one because this, in a roundabout way, gets to which of those is the foundation that they kind of make us work for a little bit. They say, which of the following components of internal control contributes most to a strong control environment? So, we're like, all right, control environment, tone at the top. Let's find the thing that's tone at the top, and there you go. So B is the one that has to do with control environment. These others have to do with something else. It wasn't as in a roundabout way as I thought. It's pretty direct. These are all, my notes about these are easy, obvious, more of the same. 8 is a good one to look at though. During consideration of the internal control structure in a financial statement audit, an auditor is not obligated to search for significant deficiencies in the operation of the internal control structure. So, and we haven't defined that yet. I think that comes in the next section, but it's kind of a vague definition anyway. But we're not required to search for those things. They should come about along the way of us doing what we are supposed to be doing, gaining understanding, assess risks, testing controls, and that kind of thing. So along the way, we do become aware of what we'll define in a minute, significant deficiencies and material weaknesses. We're not required to search for them specifically. So 8's a pretty good question. The that's not what we're doing, but we do come across them, and we are required to communicate them when we do find them. And we mentioned that in the communication chapter earlier on, right? Things we're supposed to communicate to those in charge with governance, any identified significant deficiencies or material weaknesses. So 8's a good one. How about 9? Another way of saying that same thing. Auditor would most likely be concerned with blah, 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 whatever has to do with financial statement stuff. There's a million different ways they can ask that. Let's see. 10 is kind of easy because the only other thing we would have the opportunity to do would be observation and inquiry. So it makes that one kind of easy. 11, which of the following techniques would most likely provide us with the most assurance about the effectiveness of internal control? A and C, we wouldn't do at all. Observation is better than inquiry, is the point of this one, I think. So that's a good one to jot down and take with you. Not that you wouldn't know that. Asking something is not nearly as strong as actually observing it, right? "13 is kind of another way of asking the whole what's our responsibility thing. They hit it in a little different way, but it all comes down to the financial statements again, right? An auditor should obtain sufficient knowledge of them to understand safeguards used to limit facilities. No. Procedures used to assure authorization. No. Policies used to detect concealment of irregularities. No. Process used to prepare significant accounting estimates, things that would have a direct effect on the financial statements. And significant, yeah. All right. Performing procedures in response to assessed risks in control. So really, the main thing with this in the next section are some of these definitions that show up quite a bit. Really more so in the next section. This section right here that we're looking at doesn't have a whole lot to it. You know, we're assessing internal controls. There may be a weak control environment, and if so, it's not the end of the world. It just means we can't rely on controls, and it means that we're going to have to beef up our substantive tests. We don't have to rely on any controls. We can just rely on our substantive tests, but we can't just rely on controls test of controls. Right? Definition: significant risk. I don't think we have to define that. I think we understand what that would mean. Risk that the auditor believes require special audit consideration. They do throw an example out for us that's an example where substantive procedures alone might not be sufficient audit evidence. And they said that might be the case if IT is a significant part of the entity's system, and that transactions are initiated, authorized, recorded, processed, and reported electronically without an audit trail. So they do give us that little exception where we may not be able to just do our substantive tests. We may have to get into the control tests a bit. But yeah, there's not a whole lot of good information in that section. The next one, though, yeah, significant deficiency and material weakness. These are important definitions. They're vague definitions, but they're important terms. So again, we're all about controls, internal controls, and we might identify deficiencies in those internal controls. A significant deficiency is not as, and these are our definitions essentially, it's not as severe as a material weakness, but it's important. Material weakness is the bad one, right? Or the really bad one. You know, it's a control deficiency where there's a reasonable possibility that a material misstatement will get through that net and not be prevented, not be detected, not be corrected on a timely basis. So material weakness is the worst. Okay.
You'd think it would be significant deficiency.
Yeah, it's tricky, right? I have to remind myself of which is the worst and which isn't. Specific things that might indicate, hey, you've got a material weakness are finding that fraud occurred, material or not. If you got away with some kind of fraud, that's a control problem, right? Restating previously issued financial statements to correct a material misstatement, that would be an indication of a control problem. Identification of material misstatement by the auditor that would not have been identified by internal controls, obviously. Pretty vague stuff here. So things that we identify, and this whole section is called required communications. So if we identify significant deficiencies and material weaknesses, we need to communicate those to management. That's something we're required to do. We're not tasked, not in this type of audit anyway, we're not tasked with looking for those things. We are communicating things we identify, right? So our written communication would say, our purpose is not to express an opinion on internal control. Now, there are audits where we would do that, but we hadn't gotten to that yet. So in our communication, we got to cover all our bases. You know, we're not out for issuing an opinion. We considered internal control, but that was not designed to identify all of these things and define what we're talking about, and then just say, but hey, here's what we did find. Thought you should know, right? Here's a good type of thing that, you know, this type of thing shows up in questions, you know, things we shouldn't do, and we'll get into that more in the reporting sections of the book, but we wouldn't want to issue a communication saying that no significant deficiencies were identified. That's a little strong, right? That might say, oh, good, there's nothing there, right? So we want to be more clear and say, our purpose is not to do this. We weren't trying to identify everything that's possibly there, but here's what we did find along the way. So we want to be very clear, right? And you know, we can say no material weaknesses were identified, but still not the best idea. And our last section in that case, using the work of internal auditors. So hopefully we know what internal audit function is. They work for the company. They provide assurance, you know, regarding anything really. But you know, they're in place. The company has them. We're not required to use any of their work, but we can use some of it. So we can use it to obtain audit evidence, right? So we can use, you know, the wording here, we can substitute some of their work in place of some of the work we would otherwise perform. So we can rely on some of their stuff, but there are conditions. 3 necessary conditions before we can use their work as some of our own evidence. We need to check objectivity, competence, and make sure there's some systematic and disciplined approach, including quality control. So they're not independent is the problem, right? Internal audit are not independent. So we can't share any responsibility with them, right? We can use some of their work as evidence, but we can't share any responsibility with them for any of the decisions we're making as auditors. We can't share responsibility for them for any judgments we're making. So we wouldn't have them assess things like materiality. We wouldn't have them deal with accounting estimates or anything like that. And definitely no shared responsibility regarding the audit report, right? So we need to make all significant audit judgments. So in a nutshell, we can use some of their stuff a little bit. That's kind of boiling it down a little in a nutshell. You know, their work might help us in obtaining an understanding of internal control. It might help us in assessing risk. It might also help us not have to do some of the procedures that we otherwise would have to do. If there are high risk areas, we definitely wouldn't want to rely as much on the internal auditor's work. It's we wouldn't want it to eliminate in our direct testing in those areas though. So any areas with, like we said, significant estimates, related party transactions, contingencies, uncertainties, subsequent events, stuff like that, we don't need to rely on them as much. Low risk areas, low subjectivity, good to go. We can use their work, right? We may not have to do as much direct testing there. Things like prepaid assets or fixed asset additions or even cash, you know, easy things. Okay, so if you're using the work of an internal auditor, you should read their reports, perform procedures to determine if their work was adequate. It's still our responsibility, right? And we might want to re-perform some of their work. So, you know, we need to have an internal understanding of the function that they're doing, and we need to evaluate a little bit. I think I got a little, went a little overboard with my notes here. I repeated things quite a bit. But yeah, obviously you're fully responsible for everything. And that wraps it up. Competence and objectivity are the necessary conditions. They do highlight that quite a bit. So yeah, we definitely want to, you know, they're not independent, so we're not really worried about that, but we definitely are worried about, are they competent? Are they objective, right?
How do you gauge competence?
So okay, well, let's call it, and I'm sure we're all physically and mentally exhausted. I will sign off unless anybody has anything else.